Picture this: an exchange-traded fund handing you 10% a year in cash. Monthly. Automatic. If that doesn't tickle your financial freedom nerve, I don't know what does. You start daydreaming. Wait, 10% on a $100,000 portfolio? That's $10,000 a year, totally passive. Covers rent, my phone, maybe even Friday sushi. Welcome to the marketing promise of SDIV, the Global X SuperDividend Fund. But hold on, too many of us see the yield and skip the math. Today, I want to be that annoyingly honest friend who says, hey, flip the box, read the nutrition label. You may not like the ingredients. SDIV sells 3 sweet words: monthly income, double-digit yield, global diversification. On paper, that is fried chicken for dividend fans. Tasty and comforting, but not exactly heart-healthy. And let's be real, many of us are yield junkies. We chase the high every month, ignore the side effects, then wonder why the portfolio is always in rehab. Just kidding, not all of us yet. Grab a decade-long chart. If you parked 10 grand in SDIV 10 years ago, dividends reinvested, today you sit on roughly $7,400. Same 10 grand in a plain S&P 500 index fund? About $26,000. That is the price of chasing yield with blinders on. SDIV did not just lag, it actually shrank. The high yield felt great each month, but the share price slid so far that all those checks could not keep you afloat. Rule of thumb: when price falls, the yield percentage looks bigger even if the dollar payout does not budge. A $2 stock paying 20 cents shows a 10% yield. That does not mean the company is healthy. It means nobody wants the stock. Is really return of capital. Translation: they mail you chunks of your own money and call it income. The index hunts the highest yielding 100 stocks on Earth, equal weights them, then refreshes once a year. When a company slashes its dividend, SDIV dumps it, usually after the price has imploded, and loads the next sketchy high yielder. It is yield musical chairs. Paying more than you earn erodes net asset value the way melting ice disappears. Each juicy payout chips away the glacier you need for future income. In a taxable account, you owe federal, and maybe state, tax on those monthly checks, many of which are non-qualified dividends. Your headline 10% might become 6 or 7 after taxes. Then inflation bites a bit more. Every dollar parked in SDIV is a dollar not compounding in something that actually grows. Opportunity cost never shows on your brokerage statement, but it quietly decides when, or if, you retire. If income is the goal, mix 3 barrels. 1. Core dividend growers, 60 to 70%. Think VIG, DGRO, and SCHD. These funds hold companies that not only pay dividends, but grow them consistently year after year, often around 8 to 10%. The yield might be just 2 to 3%, but over time that payout compounds and outpaces inflation. This is your long-term engine. 2. High-yield dividend payers, 20 to 30%. Here, you can lean more into income with funds like HDV or VYM. They offer a bit higher yield, often in the 3 to 4% range, but without sacrificing quality. Use this layer to increase your income today without giving up growth completely. 3. A tactical high-yield sleeve, no more than 15%. Covered call ETFs like JEPI or JPQ. These can yield 7 to 10%, but remember, payouts are flat and may lag in bull markets. Think of them as cash flow boosters, not growth tools. Use them like hot sauce. A little bit adds flavor, but too much spoils the meal. This blend gives you steady income now and rising income tomorrow. Ask 3 questions of any super dividend pitch. 1. After taxes and inflation, does total return stay positive over 10 years? 2. Are payouts covered by real earnings, not capital? 3. Has the fund survived at least 2 nasty bear markets without gutting the dividend? SDIV flunks at least 2 of those 3. I am not here to shame anyone. I held SDIV back in 2018. It felt awesome. Cash pinged my account each month. I bragged at barbecues. Until I checked my statement and saw my principal bleeding in the corner. If you hold SDIV today, do not panic sell at the opening bell, but be brutally honest. First, run your own 10-year total return comparison. Second, calculate the after-tax yield. Third, ask if you would buy it fresh at full price. If the answer is no, why cling to yesterday's mistake? Move the money, learn the lesson, keep compounding. Financial freedom is not about the fattest yield. It is about owning an engine that buys you time when you are too busy living to stare at charts. Often that engine whispers, not screams. If you value brutal honesty over get-rich-quick hype, click subscribe, ring the bell, and drop a comment. What is the sketchiest high-yield trap you ever bought? Let's swap war stories before we feed another goose that lays no golden eggs. This is not financial advice, just one guy with too much caffeine and a spreadsheet addiction. Stay curious, stay invested, see you in the next time.